benchmarks for figuring out whether a company is worth is recognizing the risk-return profile. This is just a kind of a rough sense of what different kinds of investors expect to return out of any particular investment. You've probably all heard about the 10x requirement. If you haven't, you should know that most early-stage investors look at any individual deal and consider whether the ultimate exit has a reasonable shot to produce 10 times the post-money valuation. I'm going to do this. Not the right button.
The big one.
All right. So how do you figure out what your risk is? This is actually a 9-mile labs document that I've played with a little bit, but you can look at ways to think about the business, and then going down and be honest with yourself and say, where are we on this chart? Do we have an actual product or an idea for a product that we're doing? The alpha, the beta stage? Where are we? Where's our management team? How much experience do we have? But in general, the more risk, the higher the return the investor needs to get out of the deal. So this really impacts what your hopeful evaluation will be. And the way the math works is if you go back to the 2 slides to the risk ratio from about to exit and needing maybe a 2x return or 3x return to early stage and needing a 10 to 20x return by the investor. And you look ahead and forecast out, put the financial model and say, hey, look, if we do everything right, get a couple breaks, we think we can exit this company in 5 years at $80 million. And you figure out how much money you need to raise, and look at the pre-money, you can work backwards into the pre-money valuation of the valuation by saying, I need 10 times 80, or 10 times 8 to 80 to make this all work for the investor, therefore 5 is the number. I know this because 80 divided by 10 gives me 8, so I can solve for 5. That back-of-the-envelope technique works actually more often than you think. That if it's a later stage, if you've gone farther down the path, if you've proven the market, if you've got customers, if you've got a super experienced team, the investor might say, hey, I don't really need to see a 10x here today. I can be okay with an 8x, a 7x. If it's even earlier and loosier and goosier, and you've got all theory and nothing built, they might be looking and saying, I want to see something closer to 20 out of this deal. And you got to understand, this is the part that a lot of entrepreneurs don't understand about investors. Investors too, they spend as much or more time thinking about raising money as you do. In fact, if they're not past their 3rd fund, they're extremely anxious about raising money. Each fund that they raise has to perform in order for them to do the 2nd time and the 3rd time. They're looking for returning, their competition is the stock market, real estate, all the other places, a limited partner can put their money in. If you believe that you can invest in a broad stock index over time and return somewhere between 8 and 10%, why would you put money into a venture fund if you had a lot of money to invest? Well, you need to see 12, 15, 20% returns over time from your venture investments. So if they're looking to deliver 20% to their investors, and they know that a very large percentage of their investees are going to become 0, then they got to get to these 10 and 20x returns to even have a shot to make their number. So that, working backwards to that helps sort of helps everyone understand what that valuation dance is looking like. And it's really important to know what the philosophy of your investor partner is. So there are some investment firms who are exclusively playing for sort of billion-dollar exits, very large exits. Their sort of rule of thumb is we can have a whole bunch of zeros. We can have 9 out of 10 complete failures, as long as that 10, or at least the 9th and the 10th, do really well. That's impactful to you as an entrepreneur because that really pushes you to go very big, very fast. Other firms and investors, and failures. So they're going to want to maybe see the business be a little further along, a little bit de-risked, a little bit more ready for commercialization. I often get asked, what can I do to improve the valuation of my company? And there's a couple of things. There's not that many, but there's a couple. The one is you can tell a story. You can do the research and you can tell a story about a bigger exit, about a bigger market size. In your pivoting, as you're thinking about it, it really matters how big the opportunity is. If the opportunity isn't big enough, you're just never going to get that 80 will never be 100 or 500 million or a billion. And that's the real limiter. The second thing you can do is wait longer to raise your money and de-risk. The more you get de-risked, the stronger the valuation. I think the third thing you can do, and I love the when banks compete, you win commercial. When investors compete, you win. There's a market inefficiency to early stage investing. People try to make it more efficient with angel forums and platforms and that kind of thing. But the reality is, it's inefficient for you, it's inefficient for them, and we don't all know what's happening out there, who else is interested, who isn't. If you get more investors interested, and you can legitimately walk away from a offer, you can often push up the valuation even outside of these boundaries, because when there's a scarcity of good deals, even professional investors will act. I should have had that up there. Will act irrational. Especially in places like the Valley, where the competition for good deals is very, very fierce. So we're talking about pricing rounds. This is the price rounds. There are a number of vehicles available for investors to get investment dollars into a company that don't involve actually setting price. One of which is a convertible note. I'm just going to get all these up here. Who's familiar with what a convertible note is? Anybody? Okay, so I won't go into too much detail. It's a hybrid security that's part debt, part equity. It starts as a loan. You don't set a valuation at all, and it converts into equity upon a series of events. They're very common. They got produced and created and used frequently as a way to lower the legal costs of raising money, speed it up, and kind of avoid valuation debate for as long as possible. That valuation debate tends to be sticky, slows down the investment, gets in your guys' way for raising money. So convertible notes get used quite a bit. There's been some recent changes that the market insists on. For instance, very often now you see the investors requiring that there be a cap to the conversion price. So the debt in a convertible note typically converts into the equity at a discount, usually 20% of the purchase price of the next round. Well, the investors got smart and said, that's fine, as long as that as long as it's no worse than X, a $5 million valuation or a $6 million valuation. They didn't want to come in early and get stuck with a really high valuation later. And there are a couple others you may hear of safe investments or KISSes. There's a number of ways to sort of avoid valuation early in the process. So a bit of a summary. Later stage financings, you get to use all the techniques Matt talked about. That's how M&A deals are typically, and merger and acquisition transactions are typically priced. Earlier stage, you have to go with some kind of a version of what I was explaining, where you get into a hypothetical discussion with the investor about what you think the company is going to do over the long term and how risky that is. These are the later stage financings that we were talking about before. Okay, so what's the market nationally, I guess, for seed rounds? This data is from PitchBook. It's through the first half of 2016. They have to check to see if it's been updated here. But you can see in the first graph, the pre-money valuation on seed deals has been going up steadily, and it was almost $6 million the first half of last year, with $1.5 million as the average or the median, round size. This is really interesting. Regardless of whether you're talking about all deals or software deals, the seed rounds have essentially produced about a 20% dilution for companies pretty consistently over the last several years. that gives you a good sense. If your seed round is costing you more than 20% or significantly more than 20%, you should ask yourself some questions on why that is. For Series A rounds, these have gotten bigger as well. When I first got into the business, certainly 5 million would have been a lot for a Series A. It's now pretty typical, and you can see the valuations now are in the 14 million. You can ask yourself whether that is a bubble starting to occur, right? An early warning of overpriced technology companies. And you can see also, other than the pharma world, which is that outlier graph, again, the Series A tends to cost you another 25% of your company. Please, any questions?
Hey, I got a question. All right, so let's say somebody wants, they do a convertible note, they give you, let's say, $1 million.
Yeah.
Right? So it sounds to me that they're going to get $10 million exit as kind of a promise that you're giving them, right? Like the 10x.
Yeah, but the question on the return, I didn't mention, so I'm glad you asked it. It assumes no more dilution.
It assumes no more dilution.
Right. So if you're anticipating multiple dilutive events, then you have to sort of bake them into the calculation.
Got it. So will they wind up with 20% at the end of the day, or is it going to be less?
Well, so the convertible note investor putting $1 million in, assuming that that they think you could exit the company at 10 million, would start to negotiate the cap, right? And they'd want $1 million valuation cap. I mean, it would really. You'd really want to be pushing for a much higher valuation.
You'd want to be pushing for a much higher valuation.
You'd want to say, I think this is going to be a 20 or 30 or $50 million.
So a follow-up is so you have $1 million in the bank after, let's say, it takes 3 months to close it, or 6 months. So there's got to be accounting for that $1 million too, right? Like how is that done?
So it shows up on your balance sheet.
It shows up on your balance sheet.
Yeah, you accrue interest, but you don't pay the interest.
You accrue interest, but you don't pay the interest.
Yeah, so when they convert from $1 million of debt into a seed investment or a Series A, you take the $1 million plus all the accrued interest, and so say it's a year and 7%. Right. So that's $1,070,000 gets converted into equity after discount. That's how that works.
Got it. And real quick, last question. Let's say you're a startup entrepreneur at the table. The other guy is an experienced investor. They're serious about your stuff. Who's my lawyer? Like, who do I get on my side to make sure that negotiation goes well?
Yeah, so both sides should be represented. Right. And most of the firms who play actively in the space represent both investors and the entrepreneurs. We do. Yeah. So and if you were my client and we went to talk to an investor who was also a client, we sort of worked it out to such that we can't represent both. Sure. But on that particular deal, we can represent you.
Yeah. Yeah. So, okay. All right. Thank you.
Who else?
Let's say you end up at a $10 million valuation. What I've read is it seems like their equity doubles above that cap. Is that correct on the convertible note model?
Should I do this one?